had we been 24 hours later, i.e. post that significant downward movement in the markets, I very much doubt we would have listed, because I think investors would not have signed their irrevocables. They would have said, we've got to step back. I've seen all sorts of corporate failure, and that's failure from really well-intentioned people getting it wrong, good businesses that something happens to them, it's a loss of a key customer or something in their markets, through to dealing with what I might call absolute wrong-uns who were there to try and extract value at the expense of others. We listed in March 2020, doing about 50 million of revenue and 300 odd colleagues. We're firmly heading towards 200 million of revenue, and we're nearly 1,000 colleagues, and we wouldn't have been able to get there, certainly if we just remained as a private business.
So, Geoff, thank you for sitting down with me today. Maybe for people listening or watching this that are not familiar with you, would you be able to give a quick sort of background?
Yes, well, firstly, thank you for having me. So, I'm CEO of FRP Advisory. We are a professional services business. Our background and still the core of what we do is in the world of restructuring, but we also work across effectively where there's an element of change taking place. So we have a corporate finance business that does lead M&A. We have a debt advisory business. We have a financial advisory business, which is quite broad church around anything from financial modelling to valuations to pensions to some corporate governance aspects. And then we have a forensics business as well. So fundamentally, we're accountants, but the one thing we don't do is accounts and tax in the ordinary sense. So that's the core nature of what we do.
And so, if I recall correctly, you were one of the original founders of the business, and then listed in 2020.
That's correct, yes.
Very difficult time to list. Why did you choose to list in 2020, and how was that experience navigating public markets at probably one of the most challenging times?
So our journey to becoming listed was actually somewhat longer than the event of 2020. So we'd actually been approached in 2018 about the prospect of doing so, which had followed another professional services firm listing, and we spent a reasonable amount of time looking at that, but for various reasons concluded that it just wasn't the right time for us. And then we were reapproached in, I think it was late spring 2019, by someone who'd sort of been involved previously, had gone to a different broking firm and said, look, we've got a different approach, we'd like to just have a chat with you. And then fundamentally through 2019, up to the end, and then our roadshow was right at the end of January, first 2 weeks of February 2020, and then interestingly, in terms of the impact of the pandemic, we actually listed on the 6th of March, so we were before we'd got into lockdown.
Okay.
But I do remember very clearly that when we'd sort of closed the round with investors, and I'd not done this before, and it was the day that the stock market went into very negative territory towards the end of February when COVID was becoming alive and kicking. And it was actually the day that we'd got our irrevocables from investors, and showing my lack of experience, I was to our brokers, I was like, yeah, but I assume they can all walk away from these because, the world has changed. And the message was, well, no one's ever walked away from an irrevocable. But it was clear to us, had we been 24 hours later, i.e. post that significant downward movement in the markets, I very much doubt we would have listed, because I think investors would not have signed their irrevocables. They would have said, we've got to step back, the world has changed. So we were pretty fortunate in some degrees that, we got through from there. But as I say, we came in just under the radar before the world really started to change as a consequence of the pandemic.
Yeah, wow. So it's been almost 6 months since, 6 years since then.
Yes.
As part of that journey, so first 6 years running a public company, one thing that is a certainty in public markets is you get a lot of advice. Some of it is very good, some of it is very bad. Yes. Everyone has an opinion.
Yep.
What is the best piece of advice that you've received in your capacity as a public leader?
I think as a whole, and it's a sort of not direct advice, but it's just our engagement, and it reflects actually the challenges that the market's had since we've been on, in the last 6 years, which is actually be quite clear about what you can deliver rather than what you would hope to deliver. Because, it is an absolute fact at the moment that if you overpromise and underdeliver, the consequences in terms of how you will be viewed by investors is going to be quite severe. So that whole position of being relatively conservative, we do get criticised occasionally for being a little bit too conservative, but when we speak to our investors properly, most of them would say, please carry on doing that because the volatility out there is not a helpful So I think that overall position of being, just be on the right side of conservatism is probably the best advice. And it's a natural thing given what we do anyway for a living.
And it's such a tempting world, public markets, because of the fact that it is a live scoreboard and you have all of these stakeholders that are outside of your business as well. It can be quite tempting to present a rosy picture and get the result, but that's more, I suppose what you're saying is that's more short-term greedy than long-term greedy, and it often ends up as a target for you back anyway.
Yeah, I mean, it's the way the markets work is obviously an interesting thing, because effectively you are being valued today and what you say you are going to do tomorrow to some degree. So I absolutely understand the temptation to say we're going to be super positive about achieving X or Y. We're a transactional business, and certainly one of the constants in the last 6 years has been, uncertainty is just the constant. And every time you think you're just about to hit some form of stable patch, whether it's an energy crisis, whether it's Ukraine being invaded, whether it's a change of our own government, it's Donald Trump, it's whatever that might be. There are so many things that are outside of our control that to get super positive, and it's interesting because, as I said earlier, a large part of our business is in the world of restructuring, so companies, not getting it right and ultimately failing. And, a lot of our investors say, surely we're just around the corner from some big correction in terms of our economy, and there's all sorts of statistics out there about, where corporate failure rates are. And, actually during the pandemic, the market shrunk for the first time in 30 years, which if you'd sat there at the start of the pandemic and said, are we going to see a world where corporate failures will reduce as a result of shutting our entire economy down, you would have struggled to find people at the early stages of that saying, well, of course that's going to be the consequence. It was a function of government doing their best to try and avoid that sort of cataclysmic outcome. So that whole issue of uncertainty, I think again just drives us more to the fact of trying to be reasonably conservative, because the short-term upside of being super positive, I just don't think can be matched by the longer-term downside of getting it wrong. Because if you get it wrong and you're marked down, you don't come back quickly. It's a much longer journey back to investors saying they believe your story, so to speak.
Do you think that your position as, you're a reasonable shareholder yourself, but also one of the original founders of the business, do you think that as a leader makes you better placed to prioritize the long term versus, say, a professional CEO that comes into a business and has perhaps shorter term incentives and might be more easily drawn into that process? Or is that
I'd like to think you're right on that, because by definition, my overall view of my tenure as CEO, whether that's in the private capacity or being a public company, is that ultimately I'd like to think I leave, whenever I stop doing this, that I've left it in a better place. And equally, I'd like to think whoever's going to do it next is going to do it better than me, because that should be progression. But I certainly haven't felt that I'm under a need to drive, real short-term position. And I would very much like to think that our external investors do see there's an alignment between the fact that we, it's not just me, but a number of my colleagues, a good number of my colleagues are shareholders, and therefore that longer-term position. So I must admit, I haven't felt under real pressure to sort of say, go and get those results now. But I can equally understand, and I do think if you were coming in as an external position and you're probably giving yourself some slightly short-term, more short-term targets, if nothing else, to sort of say, oh look, I've delivered. I'm doing what I'm. So I can see that there probably is a natural tension there.
And then flipping it, and I want to come back to, you're talking a lot about your colleagues and the ownership model, so I want to talk about that. But the worst piece of advice you've received in your capacity as a public leader, and you can heavily de-identify this if it's helpful.
To be honest, I can't say I have been in receipt of some really bad advice. You get a bit of conflicting stuff, and you can see, and it's not really advice, but you can see, the tensions between, say, what a broker's aiming to achieve in the context of ultimately how they might be making their money versus where we are now slightly long, we might be thinking slightly longer term, etc. from there. But I've been lucky that we haven't done anything so far where I've turned around and thought, if only I had ignored that, we would have avoided doing X or Y. Now, maybe that comes partially back into the sort of conservatism approach. But yeah, I'm afraid I'm not going to be able to give any grand reveal of saying I've been in receipt of something really unhelpful. So probably later this week that'll happen now.
Well, I mean, that's an interesting point. For the last 35 years, you've been working with predominantly struggling businesses.
Yes.
Do you think that's made you a different leader?
I think it would be impossible to say I'm not influenced by that. So by definition, I've seen, all sorts of corporate failure, and that's failure from really well-intentioned people getting it wrong, good businesses that something happens to them, be it's a loss of a key customer or something in their markets, through to dealing with what I might call absolute wrong-uns who were there to try and extract value at the expense of others. So to see all of that, I would very much say, and I'm going to sound like a real scratch record now, but an element of that conservatism comes from having seen people get it wrong. And, I think it'd be amazing if you could completely detach yourself from what you see week in, week out, from how I sort of behave in the context of running our business. And equally, I mean, even from when we came into existence, our MBO was out of a listed company that had demonstrated how not to make it work. And we are 15 and a half years on from that. But I would say that there are still some very strong guiding principles from what I saw about how not to do it back in 2010 to how we run FRP today in 2016. Sorry, 2026 even.
And other than just in general, try to be conservative, any other canaries in the coal mine that you've sort of observed that tend to indicate a business that perhaps is heading towards distress?
I mean, the most common factor for any business that ever gets it wrong ultimately is management. And management who are either out of their depth or, just were making bad decisions because, they've gone in the wrong. So management is probably the constant. But I mean, ultimately, all businesses as well can only ever exist if they have cash.
Yeah.
You can be heavily loss making, but if you're well funded by your shareholders because they want to back you through to success, then losses in themselves aren't a problem. It's the issue of do you have cash or not. So that issue around what's the right financing structure, what's the how that's approached. Again, obviously, we've seen many companies fail because they are over leveraged, and their capital structure in the end was in the wrong direction. So that issue of cash and management probably are the two key things I see.
So moving back to FRP, there aren't as many professional services firms that are listed in London as other types of businesses, and indeed the world. There have been some that have worked very well. There are some that haven't. And as I understand it, one of the reasons why it doesn't work is because the equity and ownership model, the commercial model for the partners is very different. Now, there are other professional services firms that potentially listening to this or considering listing, and they might be grappling with how to communicate that and manage it. As you've gone through that transition, one with listing the business, but also with the 15 subsequent acquisitions you've made and X number of partners that you've brought into the vehicle, what has worked well and what hasn't worked well in terms of bringing professional services operatives into PLC world?
Yeah, I mean, so as you say, the sort of cohort within the UK is relatively small, and I would love to see that change because by definition, for investors to understand a business, the more that there are around
Comparables help.
You've got that cohort,
Yeah.
the better, because by definition it's more data points for someone to say, why should I invest or not invest, and hopefully at some point we will see more of that happening, because I think that would be beneficial to us in that sense. So I mean, obviously that position of moving from as we were, what is often referred to as a sort of full distribution model, when we were an LLP before listing, the business is entirely owned by the partners. The way an LLP works is that all of the profit has to be allocated every year. There's a different issue between profit allocation and when you pay out, and again, that comes down to there's many a firm that pays out money far too quickly, borrows too much money to do so, and ends up in a bad place, but that's a different issue about how you manage your working capital. And obviously when we switched from being an LLP to a listed company, by definition we are taking external investment in. That investment did two things. One was it was a value creation opportunity for the selling partners, but also it gave us some primary capital in the context of our ability to execute M&A. We were lucky we didn't really have any borrowing, so it wasn't an issue of using it for any form of deleveraging. We were already sensibly run from there. And you've got to have that honest conversation with your partners to say, look, there is an opportunity here where there's going to be some value creation for you. By definition, we came to market primarily as an income stock rather than a pure buy and build. So we were very clear from the outset that we were going to pay out dividends on a quarterly basis and a fairly high dividend ratio. So that attracts a certain sort of investor onto our register. But that's the contract, from the outset, is those investors are investing in FRP. We are going to pay them a dividend, and obviously that dividend is going to come out of the profits of the organisation. So we go from a world where everything is available to the partners to less than everything. But there is that capital opportunity, and we actually sat down with each and every partner and did an illustration to say, look, this is the capital sum that you are going to achieve. Obviously, in the general sense, it's at a more advantageous tax rate than income tax. But we are going to be paying out dividends, and you're going to have, at one level, lower earnings going forward. But it wasn't such a drop that all of a sudden... And I guess the big test for us was, because we had a 3-year lock-in post-IPO, where if you left, there was some fairly penal terms around what you would have to give back. So the real test about had we got the model working was going to come 3 years about whether we received a number of resignations of people saying, thank you very much. I now want to go down the road because I can go back to a traditional firm, in theory, have all my profits, and I'll keep the capital sum that I'd received. Thankfully, when that 3-year position came, there was no resignation. So one would like to think that, therefore, that model had proven. So, we're still in a world where we are able to be market competitive around what we pay our partners. We've got the ability, and we'll no doubt come onto it, to use our shares as part of a wider incentive piece. But that overall balance between our ability to meet our requirements of our shareholders and we've grown not just by M&A, so we've grown by recruiting people who are joining us, primarily for an income play about what they're going to earn. But that then comes down to what is FRP as a market participant in our chosen markets. What does it look like as a place to work? And it's a slightly different topic, but life isn't just purely about what money one might earn. It's about the nature of your market position, the nature of the projects you work in, what we're asking of our team, how we engage from there. And in our chosen markets, there's some real stark choices about where you might want to work and what you want your life to look like. So it's quite an interesting dynamic on that. We can't rest on our laurels around, we've always got to be market competitive, because if we're not, then why would anyone want to work for us? But it's trying to make sure you keep that balance.
That's really interesting. I mean, hearing you describe that process you went through with the initial batch of partners sounds a lot like just standard investor relations that you might do with external investors who are coming in, and you're trying to educate them on the company's strategy, how it's going to work, and why they should stick around to make money. Prior to listing, I imagine I've never run or worked in a professional services firm, so I don't know. But I imagine as the head of the firm, you would have spent some time with the partners who are your shareholders. Mm-hmm. As that has now transitioned, you're probably doing the same, but also with external investors. Is it still the same percentage of your time that you're spending on working with investors, or how has that changed?
Well, as you raise that, one really interesting thing that one mustn't forget is that by definition there's this natural focus on our external investors because, but they're not our only cohort of investors. We still have a significant part of our register is colleagues, both partners and other, and we mustn't forget them.
Yeah.
Because the IR piece is like natural, or we get to half year and full year and fill up our diary of going to have all these meetings with different people, and and remembering that actually we've got this other cohort who are super important, if not, I might go so far, more important, because they're still in the business, they're still working in the business, and if they're not motivated, well, the rest of the results are going to be. So it's trying to make sure that balance from there. Of course, there's a bit of a challenge around the fact of being listed, and you can't share everything with everyone, and market sensitive information and all that sort of stuff from there. But it overall it hasn't been too challenging in the context of having that external set of investors as well as my ongoing internal set. And I haven't found myself suddenly being consumed or subsumed, whatever word one wants to use, by having to deal with the IR front. It's been sensible.
Okay. I mean, it sounds like the common thread through all of that is just good communication. Like, it sounds like you ran a very tight process with, I suppose, both the market setting expectations at the start, but also with, for lack of a better term, your internal investors, and that has made a big difference.
Oh, look, right from the outset, we absolutely could have sold a different story that would have got us a higher valuation on day one. But it was really obvious to me that had a real chance of going in the wrong way quite quickly. And one of the other key things was, which is I totally agree with, was when we listed, I can't remember now, I think we sold 30% of our shares. So we've got the 70% that we've got to protect and grow. So yes, fine, sell the 30% at an inflated value, run the risk that it goes wrong quite quickly, and then all you've done is damage the 70% you haven't sold. And trust me, if I've then got 50 plus partners saying, "Oh, well done, Geoff, you gave us this short-term gain on that, but the 70% now looks like we've gone down in value," it doesn't take much of a thought process to know that would have been quite damaging. So it is trying to find that dynamic on, I'm involved in lots of transactions, both as regards what we do as a business now, but just on my day job of dealing with clients. And I still think every decent negotiation should end up in a place where no party has run away with it. I often use the phrase, if everyone's slightly unhappy, it's the right deal, because then everyone's got something out of it. There's something left on the table. And I don't think that's any difference in the context of where you price things and at the outset, because yes, you could go for it, but I think it unravels and we weren't doing this for like, how do we get a quick win? It's like, how do we prove, if possible, because the professional services market being listed has not been without its challenges. How do we try and show that you can run this for a long-term basis that it's both beneficial for investors, it's beneficial for colleagues, it's beneficial for the business as a whole? And we're still working away at it. We're only 6 years into this, but that's the aim, is to have a long-term success rather than a short-term gain.
Really great point. Well, you're flying the flag for professional services firms around the world that might want to list. One of the advantages of being listed is that you can theoretically more easily use your paper. And that's something that you guys have done a lot since listing. I think when I was looking at it this morning, 15 acquisitions in the last 6 years. Has that been as easy as you had thought? So
again, because we came to the market primarily as an income stock, we didn't...
That wasn't the original intention.
We deliberately didn't come to the market as a buy and build strategy, because we were quite conscious of the fact that, not unreasonably, that the market, if you do that, expects, if you're going to execute your strategy, that you should be buying and building all the time.
Yeah.
And because we're a people-based business, we're not a product-based business, so to speak, it doesn't take much to get it wrong in bringing in a team of people or otherwise. And the contagion effect, if you get it wrong, can be really quite large. So we were like, if we see the right opportunities, we'd like to do it. Now, the reality is, for those 15, they're what I would call bite-sized chunks. We've not done anything what one might call transformational. And it's been quite interesting to hear from our investors that early doors, it was like, when are you going to do something transformational? When are you going to do? And we were like, well, hang on, we just started on this journey. Actually, in the current market, over the last couple of years, most of our investors would say, bite-sized chunks look quite sensible.
Yeah.
So using paper has been super helpful. We're very clear that if we are buying, unless it's really, really small, there has to be paper involved, because that's a really good filter about, does someone want to join FRP for the long term? Because if it's just a cash deal, you can read into that. It's just about, give me my money. And if they don't want to take paper, and again, we've got lock-in periods to say that you're with us on that, it's just a good thing about finding out whether someone is actually... Now, there's an upside, there's a downside to if the value of the shares is not going in the right direction, is using paper becomes challenging. Now we're not there, but if you had a world where the market can't reflect value through what you're achieving, by definition it will be more difficult to say to someone, look, I'd like you to place value on taking out shares. But it has been really helpful around being able to transact, understand that people are committed to joining and integrating as well. We're very clear about, we don't want to be someone who's just buying businesses to say, well, I've got an EBITDA contribution there and I've got an... It's about, there has to be a connectivity and it has to be part of it. But, the real challenge for us over the next couple of years will be, is the market recognising what we are achieving? Because for us as a professional services firm, the biggest challenge we have at the present time is we are, as a whole, competing against the private equity world, which has very, very strong appetite for professional services at the moment.
And what's been the impact of that you've observed? Just changes in valuations, or? So
there's certainly been 2 or 3 deals that we would have liked to have done, and the multiples that private equity is prepared to pay versus what we could, and it's an interesting game, because if we try and compete on there, we'll just get it wrong in the context of that. So it hasn't been too much, and again, because we've mainly been doing bite size, it's not as though we're doing platform deals, but there is a definite difference between what private equity is valuing versus what the market is valuing us, and what we are prepared to pay at the present time.
Do you see that continuing through this year as well?
Yes, I mean, my understanding is that the multiples that we saw one of our key competitors traded recently. I think it was on an 18 times multiple on a very heavily adjusted EBITDA, forward-looking EBITDA.
Wow. Okay. And going back to the overarching goal of being conservative, paying something like that is setting an unrealistic expectation.
Yeah, and of course, the challenge being listed is that the first time you do that and you put an RNS out, that's there for every other party you ever speak to, who's going to say, oh yeah, but Geoff, I know what you pay for businesses because you put an RNS out on the last deal saying you paid, 10 times or 12 times. So the ability to sort of say, oh, but we'd really like to pay sort of 6 times when you've put an RNS out saying you've transacted at something else. Yeah, it's not somewhere we can go at the present time.
Just on that, I sat down with a guy called Kevin Lim, who runs professional services business. They're listed. They do internal audit for government agencies. And he was saying that being listed has actually really helped them, not just with all the things we've talked about, but also growing organically, because they have been able to present themselves as slightly more credible because they're listed, they're in the public, and that has helped them to start, from a BD perspective, to start conversations with government agencies specifically. Has there been any sort of tailwind to the organic growth of the business from being listed, or?
Yeah, so I think as a whole, I mean, we've definitely grown organically as well as through M&A, and I mean, there's a transparency obviously to where we are. So our accounts are out there, everyone can see where we are. Interestingly, it's a slight nuance of what the question you've asked. And if we're talking to a senior candidate about joining us, and I say, well, as part of the package, we can give you share options. There's an absolute transparency to that in the sense that I can say, Alex, I'd like you to join us, and I'd like to give you that amount of share options, which will vest over the next 3 years as long as you're with us. And in reality, the only real variable to what that looks like at the end of the day is what's the value of our shares when they vest with you. I've certainly had conversations with senior candidates who are presently working for organisations that are private equity owned, but they weren't in the first cohort of vendors. And a common theme that's come out from those discussions has been the opacity to what the future equity reward looks like. So they're sort of, it strikes me, they're often very complicated waterfalls, and you're being sort of told, trust me, if this works out, it will be good for you. And when you ask for some real clarity about what that means, it's sort of like, well, trust me, it will be good for you. So I do think there's more that we need to be doing, and I would suggest that the professional services community that's listed as a whole is to say, look, yes, there's always going to be the challenge that other people are deciding what our shares are worth on any given day. But I really do like the fact that it can be quite straightforward. It's like, we can give you that. And if things are moving in the right direction, hopefully there's an increase in value from, whatever it is that, obviously if it's a nil cost option, by definition, it's an increase in value, but whatever that is. And that's one of our areas of focus, of trying to sort of say that you can make this reasonably straightforward, except for the fact that...
I think that's a great point. That's leaning into what should be fundamentally the better parts of public markets. The simplicity, the transparency of it, because of course, not to bash private equity in any way, but their investment horizon is often very fixed and a great deal shorter than yours would be in a public company.
Yeah, and look, again, I've had this conversation. The fundamental difference, I would say, about being listed versus private equity owned is like, in my boardroom, I have my non-exec chair and I have my NEDs, and they are absolutely there, recognising that they are, to some degree, the eyes and the ears of our shareholders. But they are not looking at that on a 3-year horizon or a 5-year. They're looking at where we are. If I was private equity owned, I've got someone quite rightly in my boardroom, because they own 75% of it or whatever, who is saying, we are working towards something happening fairly near term, and this is where we're going to judge you, month in, month out, about whether we're on track, we're off track. And so I do think there is quite a difference on that as well. And it certainly feels that, from my experience so far, that the conversations I have with my board and particularly the NEDs is actually about what's the longer term future. Yes, we know we've got to keep delivering as we go along. We haven't got a 5-year holiday to see if we've got a decent plan, but it doesn't feel like there's the same sort of like, when's it going to happen? Isn't it happening immediately from there?
Actually, just on that, and I'm not sure if you recall, but when you came to one of our dinners, I asked you the question, what is an underrated board skill? And you had a brilliant answer, which I've since shared with other people. I'm not sure if you remember it, but you were talking about conversations you're having with your NEDs and the relationship there. Do you remember what you'd said was the most underrated board skill that you'd observed in the last 6 years?
Probably listening. Was it listening or asking the questions about what you don't understand? Yeah.
It was listening and asking tough questions.
Yeah.
Because of course it's very easy to sit there and just wear the governance hat.
We've been blessed. So, we had NEDs before we actually listed. So, and I remember in the very early days of interviewing some NEDs, and one of them was like, I am amazing at governance. Oddly, he had a very senior governance role in a large international bank, so quite a 20 million turnover business as we were at that time. But I was like, there's no real value to our business of just having someone who's good at governance, because it was more about what value can you genuinely add to our business. And when I look at my cohorts of NEDs now, we've got different experience around people. We've got, some financial service experience. We've got some wider stuff. We've got, my chair's got lots of public experience. And it's that overall position. But I think it's having that balance where your NEDs feel confident to say to the execs, really?
Yeah.
Why are we thinking about that? But then having that, and as an exec, and again, partly because of what I do for a living, I've sat across many people who've been very, very aggressive towards me. It's like, okay, well, let's have that proper conversation. I don't feel threatened by, I think challenge is good.
Yeah.
If nothing else, because challenge gets the grey matter working. And if the grey matter's not working, then I'm not sure really, what the fun of doing all this is. So it's an interesting dynamic. But yes, I'm sure there's plenty of people who've had not so good experiences, but so far, I've been blessed to have a really good cohort of NEDs within FRP since we listed.
Yeah, fantastic. All right, final question, because we can talk about this for hours. There's a lot of negativity in public markets at the moment, so I want to end on something positive. In the last 6 years, what have you found to be the best part of being involved in public markets?
I mean, ultimately, we've been able to make progress. And, so we listed in, March 2020, doing about 50 million of revenue and 300 odd colleagues. We're firmly heading towards, the best part of 200 million of revenue, and we're nearly 1,000 colleagues. And we wouldn't have been able to get there, certainly if we just remained, and I'm not talking about taking private, we just remained as a private business. And we've had, so the structure has worked for us. But equally, I would also say that being listed hasn't fundamentally changed our culture. Yes, we've got external shareholders and whom we absolutely have to treat with complete respect because they invest in us and they, if we're going to go and do something, they're going to, we might be asking them for more money. So, we can't take that for granted. But it genuinely hasn't caused us to stop being who we are. So, yes, of course, there is a difference. But I would say if someone was considering it, I wouldn't assume that the world is going to be completely different and you can no longer be who you were. Hopefully, by definition, one is hoping that you're always going to develop. So I would say the key thing is it has allowed us to progress in a way that we would not have been able to do had we have remained private.
Fantastic answer. Well, thank you, Geoff.
Well, thank you. Thank you for your time today.
Cheers.